The most powerful financial institutions on earth are moving money right now, not into stocks or bonds, into silver, and they are not telling you. Two separate signals just fired at the same time. And when you understand what they mean together, the picture becomes impossible to ignore. If you are watching this, you are already ahead of most people. Subscribe to SHF Money right now and hit the like button so this reaches the people who need to hear it. This is the information they do not want going mainstream. Two separate signals just fired at the same time. And when you understand what they mean together, the picture becomes impossible to ignore. The first signal came from Washington. The Supreme Court just struck down Trump's tariffs, not slowed them down, not reviewed them, struck them down. And everyone in the financial press is calling this a political story. They are wrong. This is a monetary story. This is a silver story. This is the story of what happens when the machine that funds the United States government suddenly loses one of its biggest revenue engines overnight. Here is what you need to understand. The federal government was collecting hundreds of billions in tariff revenue. That revenue was being used to paper over a deficit that was already catastrophically large. Now that revenue is gone. Not reduced. Gone. And the court didn't just say, stop collecting it. The court said, give it back. Every dollar collected illegally has to be returned. That is not a budget adjustment. That is a financial earthquake. When a government loses revenue that fast, there are only two moves: cut spending or print money. And Washington does not cut spending. It has never cut spending. It will not cut spending now. So the money printer turns back on, full speed. And every time that printer runs, the dollar loses value. Every time the dollar loses value, silver goes up. This is not a theory. This is not a prediction. This is a pattern that has repeated throughout history without a single exception. Go back to 2008. The government needed to fill a hole. They printed. Silver went from under $9 to nearly $50 in 3 years. Go back to 2020. The government needed to fill a hole. They printed. Silver doubled in months. Now the government needs to fill a hole again, a bigger hole than either of those moments. And this time, the hole is not just from a financial crisis. It is structural, built into the system by design. And the only tool left is the same one they always reach for. Think about what the deficit looks like right now without tariff revenue. We were already looking at deficits above $1.8 trillion annually. That number is now going higher, significantly higher, because the tariff income is being reversed and refunded. The government has to borrow more. To borrow more, they issue more debt. To sell more debt, they need buyers. And buyers are demanding higher interest rates because they do not trust the dollar the way they used to. Higher rates mean higher interest payments on existing debt, which blows the deficit out even further, which requires more borrowing. This is not a cycle that ends cleanly. This is a spiral. And at the bottom of every fiat currency spiral in history sits the same asset: hard money, real money, silver. But here is what makes this moment different from 2008 and 2020. It is not just the macro picture breaking down. The silver market itself is breaking down from the inside. And the evidence is not speculation. It is in the audited quarterly reports of the world's largest silver mining companies. Two of the biggest primary silver producers just released their fourth quarter numbers. And buried inside those numbers is the most important silver story of the decade. Hecla Mining reported an average realized silver price of $69.28 per ounce in Q4 2025. At the same time, the official COMEX paper price for that quarter averaged around $54.83. That is a $14 difference. That is a 26% premium above the so-called official price. Then First Majestic Silver published their numbers. Independent company, different sales book, different customers, different geography, same result. First Majestic reported an average realized silver price of $69.74 per ounce, against a COMEX average in the mid-50s, a premium of roughly $14.50, again, 26% above the paper price. Two companies, two completely separate data sets, one number, 26%. That number is not a coincidence. That number is a confession. The COMEX price and the real physical price of silver are no longer the same thing. They have not been for a while. But now the miners are proving it in black and white in public documents that are legally certified. This is not a forum post. This is not a conspiracy theory. This is audited financial data from publicly traded companies filing with regulators. So what does a 26% gap between paper price and physical price actually mean? It means the buyers paying full price are not buying paper. They are buying real metal, physical bars, real ounces, and they are going directly to the miners to get it. They are bypassing the exchange entirely, because they do not trust the exchange to deliver what they need when they need it. Industrial buyers, technology companies, defense contractors, refiners supplying sectors that cannot afford to be wrong. These are not retail speculators. These are sophisticated buyers with supply chain obligations, and they are paying $69, $70 an ounce while the ticker on your screen still says 54. Think about what that means for you. Right now, while you can still buy physical silver near the paper price, the buyers who need it most are paying a quarter more. The gap between what you pay and what the real market clears at is 26% and growing. That gap does not close by the paper price going down. It closes by the paper price going up to meet the physical market where it already is. This is how commodity price corrections happen in the real world. Not with press releases, not with announcements. The physical market quietly moves first. Then the paper market is forced to catch up. And when it catches up fast, the move is violent. The COMEX was designed in a world where paper contracts and physical delivery were close enough to treat as equivalent. That world is ending. When Samsung or a solar panel manufacturer or a defense electronics firm needs physical silver at scale, they are not calling a futures broker. They are calling the miners directly, locking in supply, paying whatever the market demands. And the market is demanding $69, not $54, not $50, $69. And Samsung is not the only one. Ask yourself, how many major industrial buyers are doing the same thing right now without announcing it? Ask yourself, how many of those bilateral deals are already locked in at prices well above what the ticker shows? Ask yourself what happens to the COMEX price when those buyers stop using the exchange as their reference altogether. The answer is the exchange loses pricing power. And when the exchange loses pricing power, the artificial ceiling on silver disappears. We have seen this happen before in other commodity markets. When the physical reality diverges too far from the paper fiction, the paper market eventually surrenders. Sometimes gradually, sometimes all at once. In silver's case, the pressure is coming from both directions simultaneously. Monetary debasement pushing demand for silver as a store of value, while industrial demand from technology, energy, and defense pulls on the same limited supply. You cannot have both of those forces running at once without something giving. Look at the price structure right now. Silver tested the low 70s twice, 2 separate tests, 2 separate bounces. Both times buyers showed up aggressively. That is not weakness. That is the market telling you exactly where the floor is. The floor is in. The days of $30, $40, $50 silver are not coming back. Not with deficits expanding. Not with miners proving the real price is already 26% above paper. Not with industrial buyers locking in physical supply off exchange at $69. The information is saying one thing clearly. The floor is built, the ceiling is gone. And here's the part that matters most if you are paying attention. You are still being offered silver at the paper price. You can still walk up to the window and buy physical metal at a price that industrial buyers in Asia and Europe and the United States are already paying 26% above. That window will not stay open forever. Once the paper price catches the physical market, the discount disappears. The moment the COMEX is forced to reflect what miners are actually clearing, the price adjusts sharply and you lose the entry point you have right now. This is the quiet wealth transfer that always happens at inflection points. It happened in 2008. The people who understood what was happening bought silver under $10 while the institutions were moving. By 2011, those same ounces were worth $50. It happened in 2018-20. The people who saw the money printing coming bought silver in the mid-teens while the system was in chaos. Within months, silver had doubled. Both of those times, the information was available. The signals were there. Most people missed it because they were waiting for confirmation that came too late. Right now, you are not waiting for confirmation. You have it. You have the Supreme Court decision that breaks the deficit math and forces the money printer back on. You have 2 of the largest silver miners in the world independently reporting a 26% premium above paper price in audited Q4 filings. You have a price chart that has tested the lows twice and held both times. You have industrial demand from sectors that physically cannot function without silver and are paying whatever it takes to secure supply. Every single variable is pointing in the same direction. The question is not whether silver goes higher from here. The data has already answered that. The question is whether you are holding physical silver when it does, not a paper contract, not a mining stock, not an ETF. Physical silver, real ounces in your possession. Because when the paper price and the physical price finally converge, you want to already be on the right side of that trade. If you are on the fence, think about it this way. You are not spending money on silver. You are transferring paper money, which has already lost over 98% of its purchasing power since the dollar was decoupled from gold, into a hard asset that industrial civilization cannot replace. You can always sell it back. The difference is that when you do, you will likely be selling it into a market where the price reflects the real value that industrial buyers are already paying today. That is not speculation. That is arithmetic. The dollar system is not collapsing overnight. This is not about doom. This is about positioning before the repricing happens. The smart move is always made before the crowd arrives. The crowd is not here yet. The miners are already moving. The industrial buyers are already moving. The monetary pressures are already in motion. And you're watching this before most people have connected these dots. 2 signals, one from Washington, one from the mines. both pointing at the same thing, a repricing of silver that is already underway in the physical market and hasn't hit the paper price yet. The COMEX still says 54. The miners are banking 69. That gap closes one way. You already know what to do with this information. The only question is when. And based on everything covered in this video, waiting carries a cost that gets higher every single day. The smart money moved quietly. Now you know why. This is SHF Money. Stay informed, stay ahead, and we will see you in the next one.